Hello friends, welcome to a quick update from Invesco Mutual Fund on the fixed income space. So the fixed income market is going through a troubled time, largely led by foreign investors selling off across emerging markets, which includes India as well. But incidentally, foreign investors' holding of Indian debt as a percentage of the overall market size is under 5%. And relative to this, their holdings in other emerging markets are much higher. Hence, the volatility caused by their selling in these emerging markets have been pretty steep compared to the kind of widening of spreads that we have seen in Indian credits. Now let's take a quick recap of what has happened. So the global economy is under the grip of this pandemic, and there is a lot of fear, and the central bankers have started to cut interest rates in order to address the potential slowdown in growth. Indian economy, on the other hand, has been slowing down for the last few quarters, and Reserve Bank of India has been taking some measures along with Government of India to address the conditions. Based on the recent announcements from RBI Governor, it appears that the MPC members will be taking some rate action shortly, and at this juncture we obviously would expect them to loosen up the monetary policy actions. How does a fixed income investor position oneself? A fixed income investor needs to be extremely cautious of the credit risk which is emanating in the market, largely led by slowing credit growth from the banking system. The banking credit growth has come down to under 7% compared to a long period average of 17 to 18% credit growth. What it means is that banks are becoming cautious and their refinancing of debt is actually slowed down. That obviously means trouble for all those borrowers who had been dependent on these banks for their credit requirements and their revolving credits and so on. So the spreads of all these credits of single A's and lowers are actually widening over a period of time. And this accessibility of credit has become a major source of trouble. Hence, investors need to be worried about that and be absolutely comfortable if and when they would like to look at that piece of the market. The other piece, which is the interest rate market, is poised for a decline amidst the slowdown which is there in the Indian economy. Along with that, obviously, there is slowdown in the global economy and the fear psychosis which is engulfed most of the financial investors. So there is a potential possibility that the interest rates in India will also move down as and when the MPCs take a decision, which could be any time between now and the next monetary policy review date. So the reinvestment risk, how do I overcome that? So obviously one needs to pick a duration of a product which should be longer than your investment horizon. For example, if you have a 1 year kind of investment horizon, we would urge investors to pick up a product whose duration is longer than your 1 year investment horizon, maybe 1.5, maybe 2 years. But at the same time, remain invested in absolutely stronger credits, which are those AAA blue chip credits and Government of India bonds, which are devoid of any kind of credit risk. So safe investments and largely encouraging investors to stay in the superior credits and with a duration longer than your investment horizon in this environment. And once the foreign institutional investors selling comes, possibly they are a marginal investor in India, their holdings are under 5%. So as and when their selling comes to an end, we possibly will see a recovery in the markets thereafter. Thank you so much.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.